Hello friends, so today we are with Mr. Varun Goyal, who is the fund manager with Reliance PMS. Welcome Varun. So we would like to understand from you your views regarding the industry. Of late, there has been this thought process which is coming out that PMS is a bull market product because we have seen in last 18 months broader markets have corrected, and there are many PMSs which month after month have kind of destroyed capital, destroyed wealth, and this is making a lot of investors kind of think that whether PMS is only a bull market product or not. Though there is a conceptual understanding that PMS is for wealth creation.
Right.
So, what are your views regarding this?
Sure. Thanks for having me. So our view on this is very, very clear. We look at PMS as asset class which is there for long-term creation or long-term wealth creation, as you rightly mentioned. We have seen, over last 15 years, I think ever since PMS industry got started way back in 2003, 2004, a lot of investors have created significant amount of wealth over a long period of time. Of course, there are bad times like the ones that we are currently seeing, where markets go through a period of correction and some amount of investor wealth does get destroyed. But depending on what product you have bought, depending on what kind of fund management has been applied, depending on what kind of risk management has been in place, I think different PMSs have had different experiences for different clients. We as a fund house are very, very clear that one of the best ways to create long-term wealth through equity is PMS. As you know, equity is the best asset class for long-term wealth creation if you compare to various other asset classes over long periods of time. And PMS, I think, as a vehicle has the right amount of flexibility, right amount of transparency, right amount of ability for the fund manager to create the required alpha. So our view is different, but I'm sure there is different kind of experiences, and therefore our suggestion to investors always is to do their research, do their homework before picking the fund house through which they would like to do the PMS.
Sure. There is another question that most investors ask, and this is again a doubt or coming a belief, right? So so I want you to clarify whether it is a right belief or it is a doubt that after the categorization of stocks between large, mid and small by SEBI, right? Mutual funds, for them the latitude is narrow, and hence for them to outperform their respective benchmarks is going to be very tough, because PMS has a flexibility room to pick and stock and hand pick stocks, and hence obviously there is a possibility of generating superior alpha. So what are your views regarding this?
So there is no doubt that SEBI has significantly tightened the fund management norms for the mutual fund industry in the last 18 months. As you rightly spoke about, there has been categorization of stocks. There is also a cap in terms of what fund can have and what percentage of mid, large and small. Also they have kind of consolidated or forced the industry to consolidate. Now you can have only one fund in one category, which in our view would lead to a lot of funds becoming fairly large in size. Now of course mutual fund had its own advantages. A lot of people prefer it for the simplicity, lower expense ratios and stuff like that. But in our view, if the mutual funds do become fairly large, the work that needs to go in to create that required alpha would also need to increase. In our view, as far as PMS is concerned, it is a much more flexible vehicle in the sense that SEBI has not put in those kind of categorization and those kind of conditions on the PMS industry, and to that extent the flexibility is there with the fund manager in terms of stock picking, in terms of fund management, and therefore we believe definitely PMS is more flexible, and therefore there is a potential for PMS as an asset class to create more alpha. Of course, this cannot be a blanket statement. One has to really pick and choose what funds one is buying, but I would definitely say that PMS continues to have that flexibility, while that flexibility continues to reduce for the mutual fund space.
Right. So this flexibility does bring the potential for higher alpha, but at the same time it also brings high risk.
Absolutely.
So in that regards, I would like to understand from you, what are the yardsticks or what are the frameworks that you follow while you run your PMS to ensure that not undue risk is taken, or whatever risk is being taken, it is a very calculated risk.
Absolutely. Yeah. So I think if I were to combine your first question with this, I know you said when a lot of people are saying PMS is a bull market product. The reason being a lot of PMSs unfortunately have not done that well, especially a lot of PMS which were doing mid and small cap stock picking. So if you see, there were a lot of funds which were benchmarked to a large cap space and had a lot of mid and small caps. And that did very well in 2016-17 when mid caps were doing well. But when the cycle turned, or when the tide turned, those are the funds which have done extremely poorly, right? So therefore, we believe it is very, very important to do two things. One is to have a very, very clear sense of staying true to the mandate. So if you are doing a multi-cap fund, it should be a multi-cap fund. If you're doing a large cap product, it has to follow and be true to the label. That's number one. Second, in terms of stock picking, I think if you see a lot of auditor issues, a lot of company managements being found engaged in fraud, there are some promoter pledge issues which are all coming in. So in our view, it is very, very important to be very, very careful about what stocks one is buying in the portfolios. We have a proprietary framework which we call the Must5 quality framework. In all the 4 PMS products that we run, we ensure that every stock that we buy follows the Must5 quality framework. Just to give you some flavor of what that is all about, we are very clear that 90% of the time permanent destruction of wealth in India happens because of levered balance sheets. Right. So if you see the 2007 to 2009 cycle, you've seen a lot of infra companies, steel companies went to IBC and bankruptcy and all that. Why did that happen? And all the stock prices became zero or almost zero, right? So permanent destruction of wealth in India 90% of the time happens because of too much debt. So one, you avoid too much debt. As a policy, we like to ensure that the companies that we are buying do not have too much debt. Their balance sheets are cleaner. If they are debt free, nothing like it. Even if they have some debt, but that debt should be manageable and easily serviceable. Second, if you see corporate governance, I think what we have seen in the last 18 months, and I will not take names, but a lot of companies, suddenly we have found issues in terms of gold plating of capex, accounting issues, auditors resigning. We have had a lot of concerns on whether the growth plans which were communicated to the investors were actually in line. So corporate governance is extremely important. And while there is no formula to judge that, but there are few indicators. So for instance, what we check is what is the dividend payout ratio, what is the dividend, to what consistency of dividend payment. So what we are saying is that last 5 years, if the management is consistently paying dividends, it means they want to share the wealth that the company is generating with the minority shareholders. Second is you look at accounting red flags. You look at debtor days. Most of the times in India, bad balance sheets will show up very high debtor days, because what happens, we show a sale in the P&L, but if the money is not recovered in time, then the working capital gets elongated and then you have to borrow to meet your day-to-day needs. So working capital cycle, debtor days is very, very important to monitor. That is again something. And I think third and the most important thing that is there is the capital efficiency. I think in times like of this, all of us are realizing that how important it is to respect capital. All those promoters and managements which have respected their capital, use their capital judiciously, we are seeing they are consistently doing well. We are seeing high ROEs, high ROEs. So for us as a threshold, we are saying that any company which we buy in the portfolio should have more than 15% ROE, more than 15% ROC, and consistently. If they do that, there is no reason that they cannot generate good shareholder returns over a longish period of time. Then we are looking at growth. So India, of course, is a growth economy. So the fourth point that we look at is what is the kind of growth that the company can see in terms of top line, in terms of bottom line, in terms of their EBITDAs and all. So growth becomes extremely important.
Sure.
And fifth, what we are seeing is that the companies that we buy have sustainability. They have a sustainable competitive advantage so that they can continue to do well.
Sure.
So these are the 5 things that go into the Must5 quality framework, and we're trying to ensure that every stock that we buy qualifies that.
Sure, right. So let us discuss, the PMS strategies that you are following. Yeah.
Okay, so we have 4 PMS products. First one and the oldest product that we have, it's called the Absolute Freedom Strategy. It is in place since 2004. We completed around 14 years in that strategy. That is a large and mid-cap strategy where what we are trying to do is to have the stability of large caps with the alpha of mid caps. So we have around 75% of the portfolio, or 3/4 of the portfolio really in the large cap space, and around 1/4 is in the mid cap space. So here we have the bluest of the blue chip stocks, some of the leaders of corporate India, and then we mix a few ideas on the mid cap side. This benchmark to BSE 200, the fund has done consistently well. We are running alpha 4 to 5% over the benchmark, which is BSE 200, and we hope we are able to do that going forward. Next we have is what we call the high conviction strategy. This we launched in 2014. It has recently completed 5 years. This is a pure multi-cap strategy. Depending on what is our view on the market, how aggressive or defensive we want to be, we change the allocation to large and mid cap space. As of now, we have around 2/3 in large cap, around 1/3 in mid cap space. So here again, we have a good mix of blue chip ideas, leaders, and then a good let's say a mix of mid cap and small cap ideas. So out of, let's say, 20 stocks, we're currently running around 12 to 13 in the large cap space and around 6-7 on the mid cap space. This again something which has done quite well over a 5-year period. We are running around 5% outperformance over benchmark, which is Nifty 500 in this case. The third product that we have is we call the Emerging India portfolio. This is in the small and mid cap space. This is a product where we are picking the leaders in the mid and small cap segment. So what I want to clarify, there is a perception that mid caps means more aggressive, higher beta, but it doesn't necessarily have to be that. A lot of the mid cap companies that we are buying are actually leaders in their space. They're number 1, number 2, number 3 in their own verticals. It's just that those verticals are small today, right? So for instance, let's say 30 years back, paint industry was a small industry, and we saw let's say some of the leaders which are part of Nifty today, those point of time, they were mid cap ideas. So we believe that as these sectors become large, some of these mid cap companies will also become very large. So these are scalable opportunities. These are companies with high growth, almost debt free, 20% plus return on equity, 20 to 25% earnings growth, and we believe that if this earning growth sustains for a period of 3 to 5 years, the earnings can actually double. Right. If the earnings actually double, we believe sooner or later the stock prices should also converge in a similar direction.
Right.
That's the broad framework in which that product is operating.
Right.
And finally, we have the fourth PMS, which we call the India Economic Transformation Portfolio. We believe Indian economy is in a flux. There is a lot of changes which are happening, and we believe the shift from unorganized to organized is one of the very, very large stories which is playing out in India. A lot of people are talking about slowdown, and some growth has come off a little bit. But we believe India can still grow at 9 to 10% on a nominal GDP growth. And even in a growth slowdown year, you see several sectors, which sectors themselves might not be growing at a very fast pace, but within that, a lot of companies are gaining market share from the unorganized sectors. And that is why we believe a lot of companies, be it in footwear, be it in jewelry, be it in luggage, they are continuing to grow at a very, very fast pace, despite the economic slowdown that we are currently witnessing. So here again, we are looking at a multi-cap paradigm. We are looking at companies in the large, mid and small cap space, 20 to 25 stocks. We are looking at earnings growth of 20 to 25%. So which means again in 3 to 4 years, we believe earnings should double. And of course, we believe if earnings double, sooner or later, the investors will also reward that fundamental performance. So that's the fourth product.
So your Emerging India portfolio, which is a mid-cap focused portfolio, I have seen the portfolio. It looks to be a very high-quality mid-cap portfolio, as you have rightly mentioned. So why don't you run through that portfolio? Sure. I would want you to cover, some of the stocks and some of the stock stories and your conviction behind those companies, those models.
Right. Okay, so EIP, Emerging India portfolio, is our small and mid-cap offering. This is a extremely low churn portfolio. I think the current year churn is around less than 15%, and we believe that once we identify good quality mid-cap names, we need to give them time to deliver. I think a lot of stories, are secular growth stories here. So for instance, we have a leader in the diagnostic space. Diagnostic is a 20,000 crore industry, only 20% is organized. And what we are seeing is that because there is a lot of trust associated with diagnostics and healthcare, people are more and more moving towards organized players. And that's why companies in these sectors, especially the leader companies, are able to grow at 15 to 20%, despite the fact that there is a slowdown in the larger economy. Specialty chemicals, I think we started investing in the space 3 years back. and we believe there are a lot of companies which are coming up in India, which are making a very material impact in the overall specialty chemical space. I think 3 or 4 secular reasons for this industry to do well. One, there is a shift from China because the labor cost has become cheaper in India. Electricity cost in India is now same as that in China. And third, a lot of US and European multinational companies are more comfortable sharing their technical know-how with companies in India than they are compared to companies in China. So we are seeing these companies growing at 20 to 25% CAGR, and we see a lot of visibility because these companies are getting 10-year projects, 5-year projects, where there is going to be continuous revenue and bottom line which will accrue to them. So we have around 10% of the portfolio in this space. We have 2 names, 2 of the leaders that we have invested in this. Then we have some companies in the luggage space. So luggage again a 25,000 crore category, and a large part of it is unorganized. What we are seeing is that air traffic in India is booming, right? So the moment you buy an air ticket, the first thing you need is a trolley bag. Another very big secular reason, which is rather funny, is that there are 1.5 crore weddings in India every year, and empirical evidence says in every wedding 2 to 3 pieces of luggage are purchased, right? Because when the girl goes from her house to the groom's house, she normally carries new luggage. That's how the tradition has been in India. So we are seeing 4 or 5 crore pieces of luggage getting sold just because of the great Indian wedding industry. So we believe that this is a space which will do very well. We have companies which are debt free, which are growing at 20 to 25% with good stable margins, good clean managements. Again, a space that we believe will do well going forward. Then we have some of the good banks. We have some smaller private sector banks which have had very tight control on asset quality, good clean management teams, good ROEs, and we believe that there is a lot of headroom to grow. As public sector banks continue to suffer, we believe the market share will continue to inch to well-run private sector names. That is another space that we like, and we believe will do well going forward. So these are some of the stories.
Sure.
So together, if I were to sum up the portfolio, I was just doing the numbers for this quarter 1 FY20, our portfolio at the aggregate level has 32% earnings growth.
Right.
You compare it with the broader market, which has delivered 2% earnings growth.
Right.
So which shows the strength of the earnings growth in a very tough macro environment. Secondly, this portfolio is on FY20 basis trading at 19 times, which we believe is very reasonable for a growth. I believe while 32% is quite high, but for the year I believe the portfolio should deliver 20 to 25% earnings growth. And the third very important thing, the aggregate ROE of the portfolio is around 19. Right. So 19 ROE, we have 19P and earnings growth of 20 to 25%. We believe is a great ingredient for long-term wealth compounding. If these companies, we believe very strongly, can grow at 20% plus for the next 4 years, and if they grow at 20% plus for next 4 years, the earnings should double. Right. And hopefully investors should reward these companies very handsomely over a long period of time.
Right. So specifically, would you like to share if your portfolio Emerging India in particular has an exposure to auto sector and or NBFC sector?
Sure.
Yeah.
So we do have exposure to auto ancillary space.
Sure.
We believe so. Okay. So the company that we own, we have one exposure in the auto ancillary space, and we believe while there is a temporary slowdown that we are seeing, but auto, if you see in the last 20-25 years, there's some companies which have delivered consistent wealth creation, and we believe while the slowdown will pass, once the growth comes back, we will see significant amount of compounding happening again in the auto space. The important thing is to identify those companies which product will continue to be in relevance even in a time of electric vehicles, right?
Sure.
So a lot of companies which are geared towards the IC engine and the products which go into that will definitely see a structural issue.
Right.
But those components which will remain unaffected,
right,
by this change. So we have invested in a company which is the leader in automotive cable space.
Right.
They do LED lighting and other kind of lamps.
Right.
And we believe that they have a very large opportunity. They are one of the top 3 companies globally,
right,
in this space. And our belief is 15 to 20% compounding over a long period of time is still possible in select auto ancillary names, and we continue to stay invested. As far as NBFC space is concerned, clearly, what we are seeing is that the funding has now opened up, but it is only available for pedigreed names, for companies which have good promoter track records with good clean managements. So what we have invested in is one of the largest auto finance company based out of South India. They continue to be AAA rated.
Sure.
They have continuous delivery in terms of performance. So in fact, this quarter also they've delivered 25% profit growth, which shows the resilience of the business model. And our sense is that while there might be 1 or 2 quarters of slowdown, over a 3 to 4 year period, we believe they will continue to do very well. Their asset quality remains pristine, and while we continue to be on the watch out for any deterioration in that, but we believe that this space will continue to be robust on a 3 to 4 year perspective.
Right. So, PMS industry is undergoing an evolution and there is an increasing interest from investors. At the same time, regulatory bodies are also taking more keen interest and wanting to make, a lot of processes standardized, which is a need of the hour.
Right.
So, Reliance is one of the institutional PMS managers. So, what are your views regarding this evolution?
So we welcome more changes. Anything which can make this industry more structured, anything which can ensure that only serious players are there, because what happens is typically in bull markets, a lot of non-serious players, if I can use that term, do come in, and then when the tide turns, there is a lot of investor pain, and then that's when SEBI also realizes that probably there is need for more regulation. I think that's what they're also trying to do. So we definitely welcome the recent paper
Sure.
that has been floated by SEBI. We believe definitely there are certain improvements that can be done in terms of how the returns are published, how the fact sheets are. There has to be some level of standardization in that. There has to be some kind of standardization in terms of what themes and what kind of products are being offered in the market. So I think good regulation is always welcome, as long as it ensures that the industry moves in a more structured and disciplined manner, at the same time ensuring that the growth trajectory also continues unabated.
Right. Thank you so much. It has been a
Thank you.
pleasure
Thank you
talking
for
to
having me. Thank you.